Welcome to the NWR Virtual Investor Conference. It's May 2020 and we're joined by Terra Capital. Terra Capital is a specialist investment manager with a proven track record of performance with a focus on risk management. Terra's investment philosophy incorporates a high conviction, high concentration approach that aims to invest in early stage companies who meet rigorous investment criteria. On the line today, we have Jeremy Bond. Jeremy Bond is Terra Capital's Chief Investment Officer. He previously worked as an analyst at RAB's Special Situations Fund at RAB Capital, which focused on natural resources. Prior to that, he was an associate at Azure Capital, where he was involved in M&A as well as capital raisings. Over to you, Jeremy, with your presentation.
Thanks very much. Thanks everyone for joining. So as we just heard, I run the Terra Capital Natural Resource Fund. Fund's been running for almost 10 years now. There's some details on the fund. I think what I wanted to focus on today, though, was really just talking about the commodity market and where we're at, because we do think it's an incredibly exciting time for commodities, and particularly a couple which I'll go through as well. I suppose on this slide, what I really did want to focus on was if you look at the cumulative return of the Small Resources Index, you can see that over the last 10 years, that index is still down almost 50%. If we move on to the next slide, this is a global phenomenon, and this next slide shows the ETF returns of a bunch of different asset classes. And you can see here that commodities is the only asset class that has underperformed or performed negatively, and indeed it's performed really significantly negatively. As we know, commodities are a cyclical industry. You get sort of long bull markets and long bear markets, and that's a function of how long it takes to build a mine. We've come out of we believe we're coming out of a deep bear market that's lasted since 2010, and we're going to talk through some of the reasons why we think we're on the cusp of returning to a commodity bull market. Commodities are cheap on every metric. This slide sort of compares them to the Dow Jones Industrial, and in fact, I think this ratio has actually got a lot worse over the last year or so if we updated that slide. Indeed, commodities, if you look at the Bloomberg Commodity Index, we're trading at a low not seen since 1974. And here, we want to explain just how we got to here and why we're bullish on commodities going forward. So if you look at the last two commodity bull markets, they did have certain things in common. You had super elevated equity markets broadly, other than commodity equities. And you then had a change in monetary policy. So in the 1960s, you had the Nifty 50, conglomerate craze, super high elevated equity valuations. And then you had the end of Bretton Woods. Now from there, commodities surged and commodity equities increased ninefold over the next 10 years. And the 1990s, this probably read 2000s really, you had the dot-com bubble, again, super elevated tech valuations. And at that time, you had just finished the economic crisis. So you had 10 trillion of foreign exchange holdings. And post that burst of that tech bubble, again, the commodity index increased fivefold over the next 10 years. Now, currently, we have, well, until fairly recently, fairly high historical equity valuations, particularly in the FANG stocks, and we think that's driven by passive investing and a few other things. And at the same time, on the monetary policy side, we have, well, it says $13 trillion of that. That's increased significantly recently. So you have huge amount of sovereign debt, a lot of it with negative yielding, which is, again, a fairly interesting monetary policy change. So if we look what's happened now post the corona in the resource market, you've seen huge monetary and fiscal stimulus provided to the markets. The like of not seen since the GFC. If we looked in the GFC, post that monetary and fiscal stimulus, the price of commodities rose significantly. Now, in that period, you'd come off a 10-year bull market in commodities, so supply was relatively prevalent, and so that bull market didn't last. That equity price, the commodity prices didn't stay elevated for too long. In fact, they collapsed in 2010. Why we're excited now is I think the fiscal, particularly the fiscal spending, is going to outdo anything we saw in the GFC, and I think a lot of that will come by infrastructure. So you've seen China commit to already $600 billion of infrastructure. We think that goes a lot higher, but I think more importantly, it's probably going to be a global infrastructure spend that we really haven't seen before. So in the US, it's one bipartisan stimulus measure I think that they can agree on. I think the same will be in Europe and probably the same in Asia. So here you're coming off, what's been a 10-year bear market in commodities, where supply is tight across many commodities, and so we think with elevated demand through the infrastructure spend, it's a pretty exciting time to be invested in commodities. Now we're going to talk about a couple of commodities that we like, and then I think, as we said before, we'll keep it pretty brief, and you guys can ask questions afterwards. So one of the commodities, or one of the groups of commodities we do like at the moment is the precious metals, particularly on the gold side, but also silver, which we'll sort of get to in a moment. So in periods of sort of what we'd call maybe unruly monetary policy, gold tends to be a standout performer. One of the knocks on gold typically is that it's a non-yielding asset. Given now interest rates at zero and indeed negative, that knock probably falls away. And just the huge amount of debt taken on, both corporately but sovereign debt, means that countries are really going to resort to currency devaluation and inflation ultimately, we think, both of which are super constructive for gold. And we can see here in the presentation, you can see the ETF adding of gold has been significant, and so there's a lot of reasons at the moment, monetary policy driven, that we like gold. Now, silver is also interesting. Historically, silver is sort of the poor man's cousin of the precious metal complex, but when you get a bull market in silver, or in precious metals, silver typically outperforms gold, and indeed the bull markets in silver can be quite aggressive. So the gold-silver ratio is at all-time highs, obviously in favour of gold. So on that basis, we are looking to add within the portfolio some silver names. And if you look back at the last silver boom, there were some fabulous fortunes made. You look at Silver Standard, which was financed at sort of 70 cents odd, I think, with a full warrant, ran to $40. Pan America, financed at 50 cents, again ran to $40. So when the market gets going in that commodity, it can really get going. Which probably then brings me to the next commodity, which is my personal favourite, which has been one of the most out of favour commodities now since we've run the fund for 10 years, but one in which really does get the animal spirits moving in the commodity world. There really is no bull market like a uranium bull market, and we're finally starting to see some joy. So it's the best performing commodity this year. The spot price is up around 40%, but coming off an incredibly low base. I know the Tribeca guys are probably going to speak in depth about the uranium market, so I'm not going to go too far deep into that market. But what I just wanted to give maybe some history about where we've been and then where we think we're going to go. So typically, the uranium market has been fairly poorly managed. The two largest producers, Cameco and Kazatomprom, account for around 40% of global production, and they had taken a quantity over price approach to that commodity for a long time. Now, not dissimilar to the iron ore market, where you saw, and up until about 2015, you saw the iron ore producers do the same. Now, 2015, those guys decided that price was more important than quantity, and what you've seen in that iron ore market now is relatively elevated price for a sustained period of time. We think finally in the uranium market, both Cameco and Kazatomprom have come around to this notion. So last year you started to see them take pounds out of the market. So Kazatomprom cut, I think it was around 25% of their production. Cameco around the same, and indeed Cameco started fulfilling their contracts with utilities by buying into spot rather than producing themselves. Now, what's happened since COVID is that you've had serious mine disruption. So you've seen a lot of mines come offline. And I think listening to both the quarterlies from Kazatomprom and from Cameco, you got the sense that taking the mines offline was a COVID decision, but bringing them back on will be a price decision. And the intimation from the Cameco call was, you know, without a 5 in front of their long-term contracts, they're really not going to come to the party. And if you look at where that market is, the International Energy Agency estimated that the fully loaded price to produce a pound of uranium is around $55 to $65 a pound. And that includes, you know, your cost of capital, project development. But, you know, for a uranium price, even after a 40% rally, is still at $34 a pound. There is no incentive at the current price for any production, new production to come online. And as just discussed, there's not even an incentive for Cameco to produce from their mines at this price. So the last time we had a bull market in 2007, the price of uranium went from $10 to almost $150 a pound. And, you know, stocks like Paladin went from 0.2 of a cent to $10. Though the memory of those bull markets, I think, is still strong. Again, a bit like the silver, there was some fabulous wealth creation during that period. Now, we're not necessarily suggesting that the price of uranium is going to go to $150 a pound, but there is a lot of similarities about what's happening in that market then in 2007 to what's happening now. So in so currently the demand is still incredibly strong for uranium. I think it surprises a lot of people that you know, consumption of uranium was the highest it's ever been last year. So the demand isn't an issue, but this is a supply story. So as in 2007, Cigar Lake's come offline, and as in 2007, you have other producing participants in the market. So you have Uranium Participation Corporation in Canada, you have Yellowcake in the UK, amongst a few others, who have raised money, and they buy uranium, and so they take pounds directly out of the market. And now you have Cameco participating in the spot market as well. So, you know, for these reasons, we do think that this price rise will continue. And we think until that price rises on a contract basis, at least to over $50, you are going to see Cameco and Kazatomprom, you know, play the game that they're playing, all of which is hugely bullish for uranium. I mean, last time we had the uranium bull market, Cameco traded, I think, at a multiple of about 40 times earnings, trades at about 15 times now. And so you can see that the scope of what can happen in this market. And back to the iron ore analogy, I think once the iron ore guys sort of sorted out the market in terms of pricing, you know, you now see where those businesses have evolved. So if you look at Fortescue, you know, paying big dividends, even the big boys, Rio and BHP, paying big dividends. I mean, who's to say that the Cameco and some of these companies can't become dividend-paying businesses? So, you know, we remain incredibly bullish uranium. That's it. I think we're going to open up mainly just for questions today. So, yeah, fire away.
Thanks, Jeremy. That was great. You covered off, you know, gold, silver, uranium, the works there. So maybe if we could just go back to gold, which you started with. Sure. How are you playing the current buoyancy in gold at the moment?
Yeah, good question. So the way we typically invest in most commodities is really the same. So we are a small to mid-cap fund. We invest globally, so we predominantly in Australia and Canada. So we like to hold a basket of companies within each commodity, typically holding 1 or 2 producers, 1 or 2 developers, and then 1 or 2 quality exploration, late stage exploration stories. So, you know, we own Red 5, for instance, in Australia. On the development side, we own EMR, Emerald. And then for the exploration, we own Oklo, for instance. And so that's typically the way we construct our commodity portfolios. the bigger investment being in the producers, and then sort of sizing down as you get down to the explorers.
Mm-hmm. So a combination of stock-specific and region-specific approach there.
Yeah, exactly.
And what about in uranium? What are your favourite names in uranium right now? Where, as you pointed out, it's finally starting to see some joy, that market.
Yeah. So again, a bit the same, albeit in uranium, owning producers is a little bit harder, given that there's only really two you could buy, or two meaningful companies you could buy. So we probably focused a little bit more on the developers. So looking at probably companies with assets that had been producing that are now on care and maintenance. So, for instance, we own Lotus, which owns the Calacara deposit, which Paladin originally had in production. We think the guys there have done a good job of getting that into a position where if this uranium price continues to run, that's, near the top of the pack of a company that can come on and start producing. On the exploration, we own NextGen in Canada, which, just a fabulous asset, one of the greatest probably undeveloped commodity assets in the world, I think. But super high grade in the Athabasca. And then we own Peninsula, which US focused. So I think it's important to have possibly some US exposure in the uranium space. And then we own Cameco and stuff like that as well. So that's sort of how we play.
So just to recap, it sounds like you love all your children equally, gold, silver, uranium. Correct me if I'm wrong there, but gold, obviously you pointed that out first in your presentation, and that's on the basis of a couple of things, primarily currency devaluation. You're expecting the market to be quite strong in the future there. And also then you pointed out silver. The gold to silver ratio, as you did point out too, it is at an all-time high. Do you expect that will continue, or do you expect silver to appreciate significantly to pull the ratio back a bit?
Yeah, I mean, look, as I mentioned in the presentation, typically when you get really strong precious metal rallies, silver actually does outperform gold. So given we think we're coming into what we think is going to be a long precious metal bull market, I would think that the gold-silver ratio would start to squeeze in favour of silver. It's a harder commodity to play than gold, particularly if you're only investing in Australia. I mean, most of our exposure to silver is in Canada, but it really hasn't rallied at all like the gold price has recently. But we would expect that ratio to maybe normalise a little bit more than what it is now.
Mm-hmm. And a little bit more maybe about your approach to investing in general, Jeremy. So you don't have a long short strategy with your funds?
Not long only.
Long only. And are there any commodities or sectors that you avoid? No,
so typically, we'd like to think we're fundamental investors. So, it's really the investment decision is on a company by company basis. Now, every now and then there will be thematic overlays. So, in this case, at the moment, we are quite heavily weighted, as you can probably see from the presentation, gold, silver, and uranium. But we still hold, nickel companies, copper companies. But yeah, we like to think within the commodity that we're investing in, we're picking what we think are the best producer, developer, explorer within each commodity. Mm-hmm. Until recently, we would meet face to face with an awful lot of companies and spend a lot of time going out to site.
Boots on ground approach.
Yeah, it's a little bit different now, obviously, but that's typically the way we'd invest. We don't make a heap of investments. We see a lot of companies typically, and we probably make an investment, I don't know, once a quarter maybe, or once every couple of months. So we typically like to find companies we like and hold them, for a longer term period. Mm-hmm. And we run the portfolio relatively concentrated.
What is that longer term period? What does that look like? Is that like a 12 to 18 months?
Sometimes, but sometimes longer. Like some of the positions we have in the fund, maybe 5 years we've had those positions for. So yeah, it depends on the company.
You hope so with some of the uranium names.
We haven't held the uranium names for 5 years. Although I must admit, I have been excited about uranium for 5 years, but we have held off buying until relatively recently.
Nathan wants to know, he just sent through a question then, what is the view on mineral sands products and producers in the midterm, 2020, 2021? You haven't spoken about that.
I mean, to be honest, that's not a commodity. The knowledge base isn't as high on mineral sands probably as it is on some other commodities. Look, I do like it. It's hard to find good exposure. There's not a heap of mineral sand companies out there, but I think like there are a few that are really interesting, and there's a few that we're looking at. We don't actually own any at the moment, but there is one or two that are pretty high up on the list of companies we're looking at the moment. I might probably tell you after we've bought them though.
And what are the best performing stocks held by Terra? And even perhaps if you could tell us the best investment result that Terra Capital has achieved to date.
Ever in the fund? Okay.
Since inception, or maybe if we could drill down into the last couple of years. I
can't remember, to be honest. I mean, we had some great success in 2017 with some of the lithium names. We were pretty early into companies like Galaxy. Like I think we bought Galaxy at 3 cents or something like that, and it went to whatever the effective price was, about 40 or 50 or something. Next Gen actually we owned maybe in 2015, which sort of went from 40 to $4 or something like that. More recently, probably the gold names have been pretty good. You know, we've owned Red 5 since 6 or 7 cents. But you know, like it's been tough. Like the resource market for the last 2 years has been tough. You know, you've had a trade war and then into coronavirus. But funnily enough, that pain in the market has only exacerbated the supply for most commodities, and now the stimulus that's going to come from COVID, I think that put the two together, and I think now, you know, we haven't had a bull market in commodities for 10 years, so we're excited to actually hopefully be able to invest in a market that's going up rather than down, as it has been for the last 10 years for us.
Yeah, you pointed out in one of your earlier slides that there's a big question mark around FANG stocks and passive investing and this approach that investors have had to markets since. Oh,
not even a question mark. I don't think it's just like, I'm not questioning those businesses. It's just that they are historically, the market is historic or previously wasn't. It's getting back there pretty quickly anyway, to historically high valuations. And as we said, in the last couple of commodity bull markets, that's also been the same case. You've had, other than commodity equities, the broader market has been expensive, and then you've had the monetary policy overlay. So I suppose it was just that slide was really just trying to show that there are things happening in the market which do look very similar to the early 2000s and the 1960s.
And just to recap, Jeremy, how has COVID changed your outlook? It sounds like you're more bullish across the board.
Yeah, weirdly, we're more bullish. I mean, I think we had the worst quarter we ever had last quarter, but I'm probably the most bullish I've ever been. I just put a bunch more money in the fund myself. And, we've been waiting for a bull market in commodities. It's been 10 years of waiting, but I do feel like we are now closer, weirdly, because of COVID. We're closer to that bull market now than we might have been otherwise, which it sounds really weird, but I mean, certainly in commodities like uranium, and then that's definitely brought forward the timeline on commodities.
Kind of cyclical, yeah. Well, thank you, Jeremy, and great to hear from you today. Great to have you on the line.
Thanks for having me. Thanks a lot.
Talk to you soon.
Talk soon. Thanks. Bye.
Thanks for listening. We have Blackstone Minerals up next. Stay tuned. Blackstone has a 90% stake in Tarkwa Nickel MPG project in Vietnam. That'll be an exciting one to listen to. We'll be back in about 5 minutes' time.